Every year, thousands of people try to beat the stock market. Fund managers, guys with Bloomberg terminals, and Ivy League degrees, and decades of experience. And the majority of them lose to a simple index fund, year after year. So here's a question worth asking. If the smartest, most resourced people in finance can't reliably beat the market, what hope does anyone else have? Well, there's one guy whose method has held up for almost 100 years. He never had an algorithm, he didn't have real-time data, no AI, no options chain, no Twitter sentiment analysis. He had a framework, a way of thinking about markets that was so clear, so logical, that the greatest investor who ever lived, Warren Buffett, called him the most influential person in his financial life. His name was Benjamin Graham. Most people under 30 have never heard of him. Today we're going to fix that. We're going to break down exactly what Graham believed, how he thought about markets, and why his ideas might actually be more relevant right now in the middle of the AI era than they've ever been. Let's get into it. I'm going to give some quick context on Ben Graham and where he came from, because it matters. Benjamin Graham was born in 1894. His family moved from London to New York when he was a baby. His father died when he was 9. His mother lost nearly everything trying to invest in the stock market. So from a young age, Graham watched money disappear. He watched people trust the market and get burned. He studied at Columbia, brilliant guy, started working on Wall Street by 20. By his early 30s, he was managing serious money and doing well. Then 1929 happened, the Great Depression. The stock market had lost almost 90% of its value. Not 20%, not 40%, 90%. Graham got wiped out. And here's where most people would walk away from markets forever. Graham did the opposite. He spent the next several years trying to understand what exactly went wrong. Not just for him, but structurally, philosophically. Why do markets collapse? Why do people make terrible decisions with money? What does it even mean for something to be worth a price? In 1934, he published Security Analysis. In 1949, he published The Intelligent Investor. These two books became the foundation of what we now call value investing. Warren Buffett read The Intelligent Investor at 19 and later described it as the best book on investing ever written, full stop. So what was in it? Everything Graham believes starts with one core idea that sounds obvious but most people don't actually live by. Price is not the same as value. Think about that just for 1 second. When you buy something at store, say a pair of sneakers, you're paying a price. That price might be fair, it might be inflated because of hype. It might be discounted because the store is clearing inventory. But the sneakers have an actual value. What they're made of, how long they'll last, what they do. The price you pay and the value you get are two different things. Most people in financial markets confuse this constantly. They see a stock going up and assume it's becoming more valuable. They see a stock going down and assume it's becoming less valuable. Graham said that's backwards. The price moving doesn't tell you anything about the underlying value of the business. It just tells you what someone was willing to pay at that moment. And markets are emotional. People are emotional. They panic, they get greedy, they follow each other off cliffs. His whole career was built on separating those two things, price and value, exploiting the gap between them. Now let's actually explain how that works. Graham used one of the most famous metaphors in the history of finance, our good old Mr. Market. Imagine you own a small business with a partner. Every single day, your partner, Mr. Market, knocks on your door and offers to buy either a share of your business or sell you his share. And the thing about Mr. Market, that he is completely, genuinely unhinged. Some days he shows up feeling amazing, the economy's great, the future's looking bright, he's absolutely euphoric. And on those days, he offers you a really high price for your share. He wants to buy you out. Or he'll sell you his share, but only at a premium, because things are going so well. Other days, he shows up in absolute shambles. He's read something scary in the news, he's convinced the business is about to collapse, he's in full panic mode. On those days, he's willing to sell you his share at a massive discount, just to get out. Here's the key insight Graham is making. Mr. Market's mood has nothing to do with the actual value of the business. The business is the business. It makes the same products, employs the same people, has the same assets. Whether Mr. Market is euphoric or suicidal has zero bearing on what the business is actually worth. So what should you do? Ignore his mood entirely. If he shows up and offers you a share at a ridiculous discount, take it. If he shows up and offers you a crazy premium for your share, sell it. If neither of those is true, just close the door and come back tomorrow. You're not obligated to trade with Mr. Market. That's the point. You're only obligated to act when the price he's offering is clearly disconnected from the actual value. Now let's apply this to the stock market today. Every single day, the market opens and gives you a price on thousands of companies. That price is determined by millions of people, many of whom are reacting to news, fear, hype, and social media. Most of the time, that doesn't necessarily have anything to do with the underlying business and what they're actually worth. Graham's investor sees the market as a source of opportunity, not a source of guidance. The market, Mr. Market, is sometimes right, but he's often not. And when he's not, that's when you move. So if the price isn't value, how do you figure out what something is actually worth? This is where Graham introduces the concept of intrinsic value. Intrinsic value is the real underlying worth of the business, its earning, its assets, its debts, its future cash flows. In a world of AI and tech, You can find out these things faster than ever. You don't look at what people feel like paying for it. You look what it's actually worth if you strip away the emotion. Graham was obsessed with this. He wanted to calculate it, put a number on it, make it as objective as possible. Now look, the honest truth is calculating intrinsic value isn't an exact science. Two smart people can look at the same business and come up with different numbers. But that's fine. Graham knew this. This is why he paired intrinsic value with his most famous concept, the margin of safety. This is probably the most important idea in this whole video. Here's the concept in one sentence. Never pay full price. Buy things worth more than what you're paying, so even if you're wrong, you're still okay. Graham uses a simple example. If you're an engineer building a bridge that needs to hold 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold 30,000 because you know your calculations might be slightly off. Because real conditions are unpredictable, because having a buffer is the difference between a mistake and a disaster. Investing is the same. If you think a business is worth $100 per share, you don't buy it at $100 per share. You try to buy it at 60 or 70. That gap, $30 to $40, is your margin of safety. It means even if you were slightly wrong in your valuation, even if something unexpected happens, even if the business underperforms your expectations for a couple years, you still probably didn't overpay. You still have a buffer. That sounds simple, but almost nobody does it. No one has the discipline because buying at discount requires patience. It requires waiting for Mr. Market to show up panicked, offering you something cheap. And most people can't do that. Most people see prices going up and they feel like they need to jump in right now or miss out forever. Graham called that speculation, not investing. Investing to him was deliberate, analytical, and patient. You knew what something was worth, you waited for the price to drop below that, then you bought. That's it. Graham also made a distinction that not many people talk about, but I think it's really useful for where most of us are at. He split investors into two types, the defensive investor and the enterprising investor. The defensive investor is someone who doesn't want to spend a lot of time on this. They want reasonable returns, they want to protect their capital, and they don't want to do too deep of analysis on individual businesses. Graham said this person should own a diversified mix of stocks, bonds, solid established companies. Rebalance regularly and don't try time the market. Just hold. Sound familiar? That's basically the index fund strategy most people are told to follow today. Graham was describing it in 1949. The enterprising investor is someone who's willing to put in real work, study financial statements, analyze individual companies, actively look for situations where Mr. Market has mispriced something. These people can potentially earn better returns, but only if they genuinely do the work. Not if they think they're going to do the work while actually just following tips on Reddit. And here's the honest part, Graham included, that most finance bros won't tell you. Most people should be defensive investors. Not because they're dumb, because their enterprising approach requires a level of discipline, emotional control, analytical rigor that most people, including professionals, don't actually have. Knowing which category you're in is half the battle. And being honest. Okay, here's where things get really relevant. We are living in one of the most emotionally driven markets in history. Think about what's happening right now. AI is the biggest technological shift ever since the internet. Nvidia has become one of the most valuable companies on earth. Every company in the S&P 500 is slapping AI somewhere in their earnings calls. New AI startups are getting billion-dollar valuations before they've made $1 of profit. And the average person on social media is watching this happen in real time. Seeing the stock chart go vertical. Hearing about people who bought Nvidia in 2022 and made 10x. Feeling like if they don't get in right now, they'll miss the biggest wealth event of our generation. That is Mr. Market on steroids. The emotional intensity around AI right now is crazy, bro. The environment that Graham spent his whole career warning about, because here's the reality. AI is real, it will change everything. No one is seriously disputing that, but the price you pay for exposure to that change matters enormously. If you buy a company at 50 times earning because you believe AI will make it dominant, you might be right about AI and still lose money. Because if the market was already pricing in that dominance, there's no gap, there's no margin of safety. You paid full price or over it. Graham would look at a lot of what's happening right now in AI markets and say, that's not investing, that's speculation. You're betting on sentiment staying high, not on value being underpriced. That doesn't mean don't invest in AI as a whole. It means know what you're doing and why you're investing. So let's bring this together. Benjamin Graham didn't have a computer, he didn't have the internet, he didn't have access to the kind of data you can pull up on your phone in 30 seconds. And the framework he has built has outlived almost every other investment philosophy ever created. Why? Because it's not really about data, it's about behavior. It's about refusing to let your emotions drive your decisions, refusing to follow Mr. Market's mood. Doing the work to understand what something is actually worth, and then having the discipline to wait until the prices reflect that. So here's what I'd like you guys to take from this. 1, price and value are not the same thing. Every time you look at a stock going up and feel like you need to buy it, remember that. The price moving tells you about sentiment, not value. 2, always require a margin of safety. If you can't identify a clear discount to what something's worth, wait. There's no rule that says you have to buy something today, so don't. 3, know what type of investor you are. If you're not willing to dive deep, analyze individual businesses, be a defensive investor. Index funds, broad diversification, stay the course. You gotta be real. I'm no Warren Buffett, you're no Warren Buffett, and there's zero shame in that. 4, the AI era is making markets more emotional, not less, believe it or not. Which means Graham's framework is more useful now than it has ever been. Rational, patient, value-focused investing beats hype chasing statistically. Every time over a long time with enough horizon. The market rewards patience and punishes panic. Graham figured that out in 1934, still true today. That's it for this one. If you got value from this, subscribe. New video every week. See you in the next one.